Rising interest rates can be scary, especially when you're new to investing, but it is important to know that interest rates are only one factor to consider when investing. There are many other variables that will ultimately determine the outcome. For instance, the market is also prone to volatility, and you should never invest money that you can't afford to lose. You probably clicked on this video because interest rates and inflation are at the forefront of your mind, and you see how the stock market is falling as a result. Maybe you even want some navigation. Maybe you even want some help navigating this market. Well, be sure to watch this video all the way through, as I'll give you 5 strategies that I use to not only preserve my wealth in a falling market, but to take advantage of market cycles. Hey, my name is Isaac, the personal finance nurse, and I'm your guy for everything from personal finance to investing. As someone dissatisfied with nursing pay, I've created multiple sources of income through investing in the stock market, and my goal on this channel is to share everything I've learned with you for free. Anyways, a like goes a long way in helping me out to pump this content to you, and if you're new here, consider subscribing as well. So without further ado, let me help you learn how you can invest with rising interest rates. My first tip is to move your emergency fund or savings into a high interest savings account. A high interest account can provide you with a higher yield while also offering peace of mind that your money is appreciating in value. You will also be able to earn a competitive interest rate on your savings that is sure to be higher than the interest rate you're getting from your checking account. These accounts are usually FDIC insured, so you can be safe in the knowledge that your money is secure. I'd suggest looking for accounts with at least a 2% interest rate. Before opening an account, be sure to look to see if they have a minimum account balance or fees for withdrawals. My next strategy is to buy a 3-month treasury note. The treasury note is a type of bond that has a fixed rate for 3 months, but there are also notes available for terms of 4 to 52 weeks. But with a 3-month treasury note, it allows the investor or buyer to invest a set amount of money with a set return. This is a relatively low risk investment, as the investor usually knows exactly how much they will get back, and they will get the return back over the course of 3 months or so. Buying a 3-month treasury note is a diversified investment that will always provide income whether it's in a rising or declining economy. And with a treasury note, no matter which term you choose, you'll be able to invest in a country's economy with relatively low risk. The main thing you have to keep in mind is that you can't withdraw these funds until the time period is up. This is great if you like to diversify your emergency fund or savings while putting money you may not need right now to work for you. My third tip is to diversify by investing in dividend stocks. Dividends are a type of return on investment. Dividends are the money paid out to shareholders of a company after the company has earned profits. These funds are used to pay for the company's day-to-day operations as well as to reinvest in the company. Investing in dividend stocks is a way to invest in a rising interest economy as well as a way to invest in a company's potential future earnings. Choosing reputable dividend stocks with strong fundamentals and cash flow is a relatively safe investing strategy. In fact, dividend stocks are actually one of my favorite passive ways of investing. Most dividends are paid out on a quarterly basis or every 3 months, and this is a great way to either increase your position size in a company or simply use these dividends as a form of passive income. The key to investing in dividend stocks is to look for companies that are growing their earnings like JP Morgan and Philip Morris, because these companies have seen or yield a steady stream of income for the last decade. I'd encourage you to be a history nut. Go and look at the history of their dividend payouts. Look for companies that have a track record of increasing their dividend payments over years, even decades. One word of caution though when investing in dividend stocks is to make sure that you aren't just chasing the highest dividends. Sometimes you'll see stocks with 25% dividends, but I'd encourage you to look at the numbers of the company. Are they actually increasing their free cash flow quarterly? Are they profitable? Do they have a history of increasing or at least maintaining their dividend? If the answer is no, look elsewhere and don't risk it. Sometimes companies will advertise a really high dividend to attract investors, but recall this is a cash grab on their end that will not be sustainable for investors. Now, my fourth tip is to invest in gold. Gold is a classic investment, also known as God's currency, for its use as currency from the very beginning of time and being a reserved currency throughout the world. Gold is a safe investment because it is not affected by the markets and it's not affected by inflation. Gold never loses value even if there are rising interest rates that's going through the economy. Compare gold to the dollar. The dollar is essentially debt, given that our country is in trillions of dollars worth of debt. Since the dollar got taken off the gold standard, it has become more susceptible to market swings, especially inflation and rising rates. Now, gold gives a return on the amount of money invested, and the value of gold will continue to grow as long as there is a scarcity. In fact, over the last few years, many people have been investing in gold because they believe that it will be the key to long-term wealth. What's more exciting? Well, talking historically, we can all agree that gold rallies right after a recession and it improves faster than housing and stock markets. We're already seeing the housing market cool off. Stocks are falling as well. Here's a little homework for you. Look back at the 2008 crash and tell me in the comments what happened with gold during this period. My fifth tip is to average into a position. When averaging into position, you are investing small amounts as the price of the stock falls. It's really hard to catch a market bottom, and I see a lot of new investors putting a ton of money into the markets right now. However, with rising rates anticipated, the market may continue to fall or trade sideways for months to even years from now. The safest way is by spending a little bit of your investing money at a time. For example, if you like growth stocks like Meta, now would be a great time to start a small position. Then if it continues to fall, as we've seen historically with growth stocks during recessions, then you can buy a little bit more of the stock at a cheaper price, thus reducing your buy-in price. Now, interest rates may be gradually rising on investments as the Federal Reserve continues with its plan of tapering its stimulus. Rising interest rates will also have a significant impact on how an economy operates, especially because interest rates are very influential in the economy as they affect everything from markets to trade. But whether you're an individual, a business, or a government, rising interest rates can be a huge headache because let's all agree that, well, the market today is so unpredictable. Lucky for you, doing something about it like the strategies I mentioned can save your money from going down the drain. There are a few items that you'll need to be aware of in order to be successful. The first is to plan ahead and to have a goal in mind. Next, I recommend sticking with a low-risk investment that will take time to grow. Finally, be patient. This is one of the most important things to remember when investing. Hey, if you got value out of this video, please leave a like and consider subscribing to the channel if this is your first time here. I make bi-weekly videos on everything from investing in the stock market to personal finance tips. Hey, I look forward to seeing you all on the next video. Peace.